And then thank you everybody for joining us today. I also would like to introduce John Auer. He is a client success manager at Alliance Reinsurance Company, and I'm Angie O'Day, the client success manager at Providence CPAs. So, just a brief disclaimer, we want to note that the information provided here is general in nature and may not apply to individual situations. Captive insurance and alternative risk planning involve complex legal, tax, and financial considerations, requiring the guidance of experienced professionals. This presentation is not intended as formal legal, tax, or financial advice and should not be relied upon as such. So we've got a lot of great things to cover today. So this is what our agenda looks like. First up, what is private? What is a private insurance company? History of private insurance companies. Why create a private insurance company? Types of self-insurable risks. Actuarial assessment samples. Benefits of a reinsurance company. Ideal structure of a reinsurance company. A tax unicorn, the ER3 plan. We'll wrap it up with Q&A from you all, and then we'll talk about what next steps can look like.
Very good. Thank you, Angie. Well, we're going to start with what is a private insurance company? It's basically a company related to one or more operating businesses. They're established to provide risk mitigation. It is insurance, and we are using an actuary to identify and validate risk exposures relative to every business and client that we serve. And it allows business to realize underwriting profits that would otherwise go to the commercial insurance company. Otherwise said, today, if you write a premium check to State Farm, Zurich, Federated, etc., they get that premium and, may or may not satisfy your claim. In private insurance, you're remitting that, but you get to participate in the underwriting profits. And that's why they're so popular. The history of insurance goes way, way back to the 1600s. If you think about the time of Moby Dick, when the ships left the 13 colonies looking for whales and whale oil, which really lit up the whole cities back then, they were underinsured. So self-insurance really started, 200 or 300 years ago. It blew up at the turn of the century with the Industrial Revolution, the American Industrial Revolution. Steam engines changed everything relative to production, and we're talking like 500% increase in production. Well, steam engines led on to fires. So if you think about the day of Henry Ford, Andrew Carnegie, the Rothschilds with textiles, they were underinsured and had to self-insure their risk in order to, operate their risk management along with their companies. Then the 60s blew up, meaning the 60s and 70s, what was very trendy then was to park an insurance company offshore. You've heard of offshore accounts in Bermuda and Nevis Islands and Turks and Caicos and Jamaica and, Cayman Islands. That was very popular in the 60s and 70s. Now that's evolved, but I'm sure many of you remember that window. In today's modern era of reinsurance, it's exploded. It's actually doubled since 2013. And what's driving this is if you checked your insurance company premiums recently, they're going crazy. In fact, in California, you can't even get fire insurance. So either they're expensive or they're not available, which is driving self-insurance. And today's self-insurance capital in the States is about $200 billion. And they expect that to be over 600 billion by 2034. Globally, reinsurance assets increased from 2022 to 2023 by 12%. And today that represents approaching $800 billion in reinsurance assets. Interestingly, 92%, of Fortune 500s use some form of private insurance. Of course, automobile dealers are huge users of this. That's why they're always pushing extended warranties. David, if you go down to the dealership and buy an F-150 Ford truck, and they sell you that service warranty for $2,000 for 2 years, and you don't have a claim in that 2-year window, that dealer just made $2,000 in his left pocket as, tax advantage underwriting profit. So car dealers are really power users of this tool. Of course, Ronald Reagan is a big advocate of small business, and Ronald Reagan was a conservative president. He worked with the Democratic Congress in the mid 80s, and they pushed this into the U.S. tax code. So for 40 years, this opportunity, self insurance, has been in the U.S. tax code. And of course, it's recognized by the IRS and Congress. We love to show this slide. When you hear about this guy out of Omaha, Nebraska, Warren Buffett, he has stacked up $50 billion in tax advantage premium. How has he done that? Because Berkshire Hathaway owns Geico, which you see those ads ad nauseum if you watch TV, and he owns another reinsurance company called General Reinsurance Company. We call that Gen Re, casually in the marketplace. $50 billion is what he's stacked up in remitted premium. When you hear of this guy buying blocks of stock at NASDAQ, Apple, Amazon, Google, McDonald's, when he's buying stock, he's buying that with tax advantage premium that he's stacked up in his insurance company. It's the same way that you can do if you're a doctor, if you're an ortho doctor, and you push $2 or $3 million into your insurance company, you can use those tax advantage premiums to deploy those in the marketplace. Investments, land acquisition, buy stock, municipal bonds, et cetera, and so forth. That money doesn't have to stay there as cash liquidity. You can put that money to work in the marketplace. What industries are perfect for private insurance? Well, every industry that has risk, which is everybody, right? I mean, name me an industry that doesn't have a risk, from hospitality to trucking to cannabis to home building to commercial construction to a franchised operation to aviation and aerospace. So all of these have different risks, but importantly, the actuary comes in and uses actuarial science to look back 100 years and say, hey, David, your CPA firm in Tulsa, Oklahoma has these 15 line items of risk. So it doesn't really matter what industry. And of course, we're talking to many medical professionals on this call, and I'm going to show you a few of your risks that you're going to inherently have. This slide just basically shows the motivating factors to turn on or launch a private insurance company. I've touched on several of those. One is to minimize your insurance cost. So once you turn this on, you're self-insuring some of your risk. You can go over to your commercial P&C and adjust that. You can raise your deductible and lower your premiums. That's done all the time. Control risk. It is insurance. So really you're mitigating risk and you're mitigating claims because now you own an insurance company. Improve cash flow. You're basically remitting premium off your books, which lowers your taxable income. But on the right side of the equation, you're stacking up tax advantage premium. So you're improving your cash flow when something comes along, you can pull that money out for claims. Wealth accumulation, yes. Thank you, David. So yeah, that's fine. Next slide really looks at, we built this slide with JP Morgan in continuing education. We advise that you don't cancel your commercial P&C. If you're using, let's say State Farm, you're going to keep them for your catastrophic risk and probably your automobile, your GL, your workers' comp, etc. But your self-insurance is going to cover some of those underinsured and uninsured risk. And those look like loss of key supplier, loss of key vendor, loss of key contract, loss of key talent, legal risk, brand risk, reputational risk, regulatory risk, business interruption like COVID, which obviously, really upset the dentist industry. It upset the restaurant industry. I mean, COVID had a profound effect on revenues in many channels. So we like this slide to show, how those different risks are broken out. Let's look at our first healthcare example. This is a healthcare example, and this gentleman is doing, boy, that's small type. I believe it's $2 million and in top line revenue at the very bottom, and they can remit about 200,000 or 10% of their top line revenue. If you look on the left, those are the business leaders slash medical professionals risk exposures per the actuary. So in this case, A through, it's so small in my eyes. David, is there a way to blow that up just a tad?
No, it's a full screen here.
It's full screen there. Okay.
It's A
I'm
through K.
struggling to see some of that data. But as you can see on the left, that those 10 or 11 or 12 line items of risk represent that business's true risk exposures. And what he can do is remit about 10% of his top line revenue. Next example. There you go. Thank you. This is another healthcare example. He has a fewer amount of line item risk, if you will. What is that, 8 or 9? But you can see what he's doing in top line revenue at the bottom, $5 million in top line revenue, and you can see he can remit between 10 and 15% of that top line revenue in remitted premium each year per the policy. Third example is another healthcare professional. You can see he has what, about 10, 15 line items of risk. He's doing about $14 million in top line revenue. This is a pain management company, and he can remit, let's call that 8 or 9% of 14 million. He'll be able to remit 1.2 million off his books as remitted premium every year, and that money is stacking up, relative to tax advantage premiums. Our last one might be dentistry. So you can see that this dentistry has, let's call that 15 line items of risk per the actuary. And they're doing, David, can you see that better than me? Is that $8 million?
About 8 million, and they've got about a million in premium.
Excellent. So they're doing $8 million top line revenue. He probably has several dentist office to achieve that amount of top line revenue, but that's what he can remit, about $1 million off his books as remitted premium. And of course, that's lowering his tax burden every year. So that's why these are so popular. You're adjudicating your risk, you are managing your claims, but you're also pushing money off your books, off your P&L as an expense called premium, and that money, David's going to show you where that money ends up. So we're pretty excited about this model.
Great. Well, thanks, Craig. So let me dip into a little bit of the tax side of it. So there's two ways that a private insurance company can get taxed. There's the traditional private insurance option, which is governed by Internal Revenue Code Section 831A. And then you have the new one, which was the 1986 legislation under President Reagan, that's been phrased the micro captive for smaller businesses. That's governed under Code Section 831B. You can see here, the differences between how they're taxed and how the premiums are deductible. And then how the premiums are then taxed to the insurance company. What is interesting here is that in both cases, once money comes out of the traditional micro captive or the private insurance company, it is taxed then as a taxable dividend. If there's investments made inside of the captive insurance company, when those are liquidated, there's also a tax. So I'm going to explain here on the next couple of slides how we've come up with a strategy to get around that, which I call this the tax unicorn. Which there's not very many things out there where you can deduct premiums going in, but if it's set up properly, it can be tax free on the backside. The traditional private insurance company strategy is not on the IRS's radar screen. The micro captive has been on the radar screen for the IRS for about the last 15, 20 years. The IRS started viewing those as being potentially abusive. The tax court has started ruling now in the last couple of years in favor of the taxpayers and not in favor of the IRS. So I think as a result of the trend, the latest trend is now the IRS is not scrutinizing them as much. We tend to favor the traditional private insurance company. Again, that's not on the radar screen. There's no limit to the premium other than what an actuary an appraiser will come up with, and then generally, depending on the company you talk to, there's certain minimum gross revenue requirements, and herein is where the opportunity that Craig and I have created over the last couple of months. When I met Craig, I asked him two questions. One was, and I've had my larger clients, and like Craig said, 92% of the Fortune 500 have some form of private insurance company. My larger clients have always loved having their private insurance company. However, most of our physician clients didn't have the minimum annual revenue. So when I met Craig earlier this summer, I asked him two questions. One is, would it be possible if I could combine the revenues of my independent contractor physician clients or my solo practitioners, combine their revenues for purposes of meeting the minimum revenue requirement? And he checked with his people and came back and said, yeah, there's no reason you can't do that. And we just had never seen that done in 35 years. And I've looked around the country and I've never seen anyone allow, the smaller clients to participate in something like that. So basically creating some type of a co-owned or co-op organization where everyone owns shares, and you basically self-insured in separate silos against the risks of your practice, so that you didn't share risk with other shareholders, other than the third-party insurance company. So that was a huge breakthrough. 95% of our physician clients now, are eligible for participating in something like this. The second piece of it that I asked Craig was, and I already knew the answer to this because I'd had some clients do this a couple of years ago, and I said, can we, can they own their shares of this private insurance company inside of a self-directed Roth IRA or Roth 401k? And the answer came back as yes. And I'd already done research and found that was that was the case. So anyway, that opened up this huge opportunity for our clients to not only create a tax deductible fund self-insurance strategy to self-insure risk, which this is a legitimate risk mitigation tool, but do it inside of the wrapper of a self-directed Roth IRA or Roth 401k to allow that wealth to continue to grow, and ultimately come back to the client as tax-free retirement income. So the way that a typical micro-captive insurance company is set up is generally you've got the operating business. They pay a premium into the micro-captive insurance in exchange for insurance companies. There's generally going to be capitalization requirements depending on what state you talk to, and that could be anywhere from $200,000 to $1 million. Again, the threshold to set up your own micro-captive is pretty high when you're unless you are one of these larger businesses. Setup costs are fairly pricey. They're up around 32% on average. They are subject to state insurance regulation or whatever the jurisdiction that you have set it up in. Generally, micro-captives are subject to regular examinations and audits, and you have to get your investments pre-approved. And then the state generally imposes a premium tax, which is kind of like a sales tax, and it can range anywhere from a half a point to 5.5% on the high end. And then you generally have to share risk with other business owners, not just with yourself and an insurance company. So there's some great benefits to having a micro captive, assuming the IRS isn't have them in the crosshairs. But there's also some significant costs with going down the path of a micro captive. If you go the route of a reinsurance company, which is what we've created here with Alliance with Craig's assistance, is we've got a third party insurance company that is sharing some of that risk, with the client. The premium is remitted after a seeding cost, which is a flat 15%, which is about half of what the industry average is for micro captives. And then that premium sits inside of the reinsurance company in liquid cash, waiting to see if there's a claim that's going to be filed against that client or that business owner. So that's how generally a reinsurance company operates. The way that, and just to give you a couple of disadvantages of the other captives, like I mentioned earlier, in addition, so this just gives you a laundry list of what I've already pretty much talked about. But anyway, just the regulation and the additional costs of a state chartered captive make them somewhat cost prohibitive and only really beneficial for the larger businesses. How insurance specialties is different. That they do not use a trust to hold the assets, which is what a micro-captive does. A micro-captive generally has to have trustees or managers, a lot more heavily state involvement. You've got roadblocks as far as meeting certain requirements and the fees, like I mentioned. Um, what Craig and I have co-created together in this new alliance reinsurance company, where our clients and other physicians and other smaller business owners that generally don't meet the revenue requirements to set their own up, we've created now an alternative or an option that is probably one of the best tax strategies that I've ever seen compared to a traditional retirement account. As you all know, if to be able to deduct a premium or a contribution into a retirement account, generally is going to result in you having to pay tax on it someday down, in the future, and you're really just kicking the can down the road, and you're hoping your tax rate during retirement is going to be lower than the tax rate that you got the deduction with. You ask around, and I don't know if a lot of people think that tax rates are going to go down, especially if you're successful at saving money and investing. So the alternative that we've created is to have the shares in Alliance Reinsurance Company owned inside of a self-directed Roth IRA or Roth 401k. I personally prefer the 401k just because of the additional flexibility and the fact that you can fund one pretty quickly with as much as $69,000 or $76,000, depending on if you're over age 49. Whereas the Roth IRA is generally slower to get started unless you already have built one up and you converted. And then also if you're over the certain income limit, you got to do what's called a backdoor Roth IRA, which basically means you just put the money in a non-deductible traditional IRA and then just move it right immediately over to the Roth IRA. So it takes a little bit more time to ramp up with the Roth IRA compared to where you could just jumpstart it with the 401k. So the way that this is designed is that the cash that sits in the checking account at the end of the year, if there's no claims, gets paid out as a dividend to the individual's Roth 401k. That money then is reinvested as directed by the client. Since this is a self-directed Roth 401k, the spectrum of potential investments is broader than if you had a 401k where you had utilized a financial institution like a Vanguard or Fidelity or Schwab. You can always still invest with those companies. It's just that through a self-directed Roth, you can do a few more things such as private equity, real estate syndications, private, and other private investments if you'd like to do that. So the flexibility of a self-directed Roth 401k is a little bit greater than a non-self-directed one, but and you can also then transfer that money back to your Roth IRA at any of those financial institutions once it comes out as a dividend. So anyway, there's the way this structure is set up. It's really just to create a tax efficient risk mitigation tool that also allows for those who don't need all of their that surplus or premium to satisfy claims. That money now goes and starts creating tax-free retirement wealth. Just to give you a little example of how this would look over a period of time, I just assume an average amount of premium going in for a client to be about $75,000, which is about the equivalent of what they might be able to put in to a combination of a solo 401k plus an IRA each year. If that money grew at 7% and they were in a capital gain rate of 30% and a tax bracket of 45%, you can see over time how much the differential between having that money accumulate tax-free inside of a Roth 401k versus inside of a traditional after-tax account. And if it was tax deferred, it's about the same place. You're just paying the tax on the back end versus gradually over time. So you can see that the long-term advantage of additional wealth being created, which really just tells you that the sooner you get this started and starting to build wealth, the more it's going to, or the faster it's going to grow. This combination that we've created, we call it the ER3. It's an Enhanced Roth Reinsurance Retirement Plan. That is just a proprietary name that we put on this because of the unique nature of it. Ideally, you want to have gross revenues in a business around $500,000. There's not a hard and fast rule there, but that generally includes clients that generally have a little bit more cash flow to be able to do something with, and they're usually in a higher tax bracket, or they start creeping into the higher tax brackets. That's an exception to the normal $1.5 million minimum requirement that generally you have to have your own private or your captive insurance company. The money goes in tax deductible based on what an appraiser assesses the premium to be, and then that once that money is no longer needed for to be kept in inside the company because the policy now is moving on to the next year, that money then the remaining money is then paid out as a dividend to the self-directed Roth IRA, assuming it stays in that Roth IRA until the taxpayer, the participant, reaches age 59 and a half. There are some exceptions to getting that money out earlier without having to pay a penalty, but generally 59 and a half years old, you can then start taking tax-free withdrawals out of that account. So just looking at the costs and the service costs and the setup costs of this, there's a one-time investment. So this is an after-tax, if it's made inside of a Roth 401k, one-time purchase of the stock in the company, which you get back when you redeem your stock. There is a 5-year holding period to be a stockholder, just to prevent people from investing 1 year and then redeeming their stock the next year, trying to keep the administrative costs under control. So a one-time $50,000 investment. As premium comes in, it goes through the CCFC insurance company. They carve off a 15% seeding fee, which covers their costs, plus allows them to cover claims above and beyond the amount of the money that's sitting in the checking account if there was a claim. There's a $7,500 one-time appraisal fee to get set up, similar to those reports that Craig was sharing with us earlier. And then there's a flat 2.5%. It actually starts phasing down as the amount of the asset grows. That's just paid quarterly to maintain. So this is an active trader business with just to administer this. So there is a going concern cost of keeping this going, and then all the tax filings in the accounting, and then anytime there's transactions entered into. The third-party custodian has some nominal fees that they charge because that's how that's the business that they're in. But generally, it's just enough to for them to maintain the reporting requirements that they have with the IRS. If assets or investments are made by inside of the Roth 401k that are difficult to value, the third-party custodian may require an outside appraisal, just because that value does have to be reported to them on an annual or to the IRS on an annual basis. So just the steps to get started. Basically, it's a two-prong track. The one is getting the investment in the self-directed Roth 401k started and funded. The second, and then that leads to investing in the company. The other track is getting the underwriting report started, and so that you have that report, and you can then make a decision of how much of those policies and premium do you want to be able to pay in. To a lot of our clients, that there's generally going to be more premium that they can pay in than they probably have cash flow available, but at least it gives them an option versus a lot of the other options out there, which are just a tax deferral retirement account. In my opinion, this will start replacing what most of our clients have done in the form of profit sharing and defined benefit plan contributions. So those are the steps that are involved. If you'd like to know more, I'm offering a 30-minute introductory call to go over your situation and decide if this is a good fit for you. There's the QRC code you can click on, or you can reach out to me at david.hour@providencecpas.com and schedule a call. So that this would be the next step, just to see if this is a good fit for you. So we're going to open it up to some questions, hopefully be able to answer some of the questions that you might have. We also are developing our own FAQ library, so we'll have that available here probably within the next few weeks. Once we've completed a lot of these calls, we're gathering all of the questions and then what the responses are.
David and Craig, I do have our first question, if you're ready. Since micro captives are under IRS scrutiny, what specific reporting requirements or potential audit risks should businesses be prepared for?
Well, the issue with most micro captives that have gotten into trouble is they either have exotic premiums that aren't legitimate risks being insured against, or the third party appraisal is inflated and is not based on what is fair market value or what other businesses out there would generally pay for insurance was if it was not inside of a tax advantaged entity. The other risk is a lot of times the money that's inside the captive is used as a personal checking account, where the client will invest in exotic investments or things like a yacht or a second home or whatever. So generally speaking, if you just keep that money invested in things that you normally would invest inside of your retirement account, you generally are going to be safe from that risk.
Okay, great, thank you. We have another question. How long am I committed to this strategy?
Well, the investment of $50,000 is a 5-year investment or holding period. So if you decide you only want to, fund this 1 year or maybe 2 years, you'll get that money to the extent that it's left over. If you don't file a claim, it's paid out as a dividend. So you have that money, with it, at the end of the year or at the end of the term of the insurance policy. The original $50,000 sits in that checking account for 5 years until you can redeem it. But you'll get the premium out on a yearly basis to be able to invest. You can move that money out of this custodial account into any other Roth IRA that you have with another institution on an annual basis. It's just that the 50,000 investment is a 5-year holding period.
Okay, and someone wants to know, in what ways does a private insurance company provide more control over risk compared to traditional insurance?
Craig, I'll let you answer that.
Yeah, sure. Angie, thank you. So typically, your 4 or 5 commercial coverages cover your GL, your workers' comp, maybe your auto fleet. But what this does is allow you to cover those underinsured and uninsured risks. So I mentioned several of those. It's going to be 5, 10, 15 line items of risk per any business leader. But Angie, I'll tell you the ones we see all the time. Everybody is underinsured on these 4 or 5 things: cyber risk, business interruption because COVID changed everything, reputational risk. I mean, think about State Farm does not cover your brand and reputational risk relative to your 5-star ratings and so what someone might say to you on Google. So you're probably underinsured in brand risk and reputational risk. Your legal risk. So 4 or 5 of those line items we tend to see all the time, whether you own a trucking company or you're a neurosurgeon. There's just 5 or 6. Now, the other things are going to be pretty germane to their industry. But specifically answering the question, the actuary, who's a licensed third-party actuary and has been doing this for 40 years, is going to look at the business leaders' risk relative to their risk exposures on top of their P&C coverage. So those coverages won't be duplicated.
All right, I think that's all the questions we have today.
Well, great. Well, again, I want to thank everyone for joining us today. Again, if you'd like to find out more and see how this might be able to apply to you and help you, feel free to click on that QRC code to schedule an initial 30-minute consultation. Anyway, appreciate everyone's time today and look forward to meeting everyone on a Zoom call if you're interested. We'll talk to you soon.
Craig,
Thanks,
thank you so
everybody.
much for your insights today. David, Angie, thank you guys again for not just today, but for the last 3 before this as well. And thanks to everyone who's attended. I hope you found this useful. Again, not a shameless plug, but I personally am a client, and I wanted to share this with everyone because I find it useful. So I hope anyone else does the same. And again, Providence CPAs that's the people to follow up with if you have any questions, and we'll post all the information with the webinar after this.
Great.
Thanks for attending, everybody.
Thanks, everyone.
Bye,
Thank
everybody.
you.